Have you ever run the numbers on your rental property dreams, only to watch those dreams unravel with one bad tenant, or maybe even a surprise $27,000 repair? Well, guess what? You're not alone, and it doesn't mean that real estate doesn't work to build wealth, and it doesn't mean you're doing it wrong. Imagine if setbacks like this didn't derail you, but actually set you up to make that long-term wealth. You're listening to the Real Estate Fastpass Podcast, where real estate investing is made real, simple, and scalable. My name is Jimmy, and I'm your host, helping everyday investors build wealth without any of the fluff. Today on the show, we're diving into a question that a lot of passive investors ask themselves. Can you really create meaningful passive income through rental properties while still keeping your day job? To help us answer that, we're joined by one of my good buddies, Derrick Shannonhouse. He was a West Point classmate of mine. He's a very successful corporate executive, and he was one of my first Vreeland Capital investing clients. And Derrick has made over 7 figures with his passive real estate investments. In this episode, you're going to learn 3 powerful takeaways: why equity and tax advantages outperform monthly cash flow. We're going to talk about how Derrick took a $275,000 initial investment and he turned it into a snowballing portfolio while still working full time. And he got all of that $275K pulled back out. Technically, his investments are running without any of his own money, and he's making an infinite return. We're also going to talk about the super smart tax move he made with his wife that offset 6 figures in capital gains. It also allowed his wife to stop working and help him massively lower his effective tax rate. And there's even a twist you might not see coming. Derrick's journey to passive income, he originally got into real estate to stop working. But what he found is the skills he gained being a passive investor made him more productive and gave him more active income and more passive income. We call that the passive income paradox. If you're ready to stop overthinking the first step and you want to start building long-term durable wealth, then stick around for this episode of the Real Estate Fastpass Podcast. All righty, and welcome back to the Real Estate Fastpass Podcast. I got a great interview this week. I got my man, Derrick Shannonhouse. You were probably the first buyer of the Real Estate Fastpass. Derrick, introduce yourself to the audience, and then let's talk about that first Fastpass you bought.
Okay. Hey, everybody. Happy to be on the podcast with Jimmy again. So Jimmy and I go way back. We graduated from West Point together. Both were artillery officers. So go back about 25 years, which is pretty wild. But
we went to Ranger School together too, right?
We did. Yep. Yeah. So a lot of those fun experiences we had. But anyway, got out of the Army after 6 years of active duty, got an MBA, worked as a management consultant for about a decade. And then I've worked in a large corporation now for about 6 years and just some senior executive roles. So, and then got hooked up with Jimmy on the real estate side. That would have been back in 2016, 2017-ish, back in the joint ops days in the OG era. And so it's almost been a decade of working together. So it's been pretty awesome.
And so talk about, we at that stage, we just got the Army, everybody's getting married, everybody's starting to have kids, everybody's getting into their career. But you were the only buddy who called me and said, "Hey, I want some real estate." What was going on with you then?
Well, so my parents bought some rental properties in like 2004, 2005, kind of right when we were in the thick of our active duty stuff. And I was definitely kind of drawn to that and didn't get heavily involved or something, but just definitely had an appetite for that and an interest and stuff. So, I mean, I give my parents some props because I learned a little bit of that from that. But then I actually bought my first rental in 2006 when I was deployed in Iraq, came home on mid-tour leave and bought it. But that's all I did from 2006 really to 2016, just because I was busy going to business school, trying to, start a corporate career and that sort of thing, get out of the military. But, as soon as it's funny, Jimmy, too, because I remember just randomly coming across you on the internet. I don't even know how I was searching or how, but I just remember kind of laughed. I was like, oh my God, I was like, what the hell is Jimmy into now or something, but right away I just, already had one rental and I just knew I had an interest in rental property. And my dad always kind of told me too, just like you always try to coach people, Jimmy, of, it's really hard to lose long-term in real estate. So just keep that in mind. That was really kind of the seed that had been planted. So So I was definitely just interested to really find out what the hell you were up to. And yeah, and it definitely evolved pretty rapidly from there and stuff. So kind of a funny story, but I feel like definitely one of those serendipitous type of experiences where it's actually kind of wild to think about. Like if I hadn't randomly come across you on the internet or however it was a decade ago, you know, my real estate path would have looked different. And that real estate path has unlocked a lot of other things. And so, yeah, actually in hindsight, it was a extremely kind of serendipitous sort of break, if you will.
And I really in the podcast, I want to get into what else is it has unlocked.
Okay.
But your mindset then, because I know at that point I was doing the whole rich dad poor dad idea. Like I need 10 grand a month. I'll get 300, $300 to $500 a door. I'll get so many doors and I can quit my job and then I'm done. Right. And then this was 2016 we're talking. So I was 36, pretty much starting the prime of my life. Like, were you kind of in the same mindset?
Yes. Yeah. No, that was that. It was all just, how many doors and what's the average amount of monthly cash flow per door. And yeah, just figuring out, kind of that financial freedom equation math of, how do you get to whatever it is, 10, 12, $15,000 of passive income. So yeah, I was absolutely in the same boat. And I felt like there weren't nearly as many people back then sort of kind of, advocating for real estate. I mean, that's like when Bigger Pockets, a lot of that stuff was just starting to become pretty mainstream. But I felt like 80% of what you saw back then, it was all just that, we'll own, 18 homes or 27 homes or whatever your number is. But it was basically just a race to acquire assets.
And now, so the whole cash flow greater than expenses, then you're great. Well, how'd that work out for you? Has that been your real estate experience?
No. So it's been interesting from just a month in, month out cash flow standpoint. It's not gone according to plan because it's just there's been some good years and there's definitely been some years where, just had to take it on the chin. But what's interesting is from an equity standpoint, and from a tax savings standpoint, those have both massively outperformed. And when I kind of look at sort of, I guess the sources of cash being just operating cash flow, cash out refinancing or tax savings, when I add up the equity piece and the cash out equity I've captured in the taxes, that's massively outperformed really anything I could have ever expected the operating cash flow to. So it's weird. I have
But that's like
won much more so than I would have expected. I just didn't win in the manner that I was initially thinking I would.
but you're a businessman, like your guy's business. What do you think you make more on? You don't make a ton of money on the operating cash flow in any business.
No.
I don't in my business. It took me, here's a secret to small business ownership that no one talks about on the internet, but it took me 3 years. I had to reinvest profits to use as operating capital in the business.
Yeah. Yeah.
Like nobody talks about that. Nobody knows that. And so that's like so my P&L would say something, but I still had no cash at the end of the day because it was operating capital for the business. And so what I've been terming maintenance and make readies, which is essentially operating expenses, it's really resident reinvestment. Just like any other business, is you take a certain percentage of the gross revenue and that goes into the operating capital of the business. And that is, Kiyosaki definitely launched us both, but I do think, and I'm glad he didn't tell us the whole truth, or I would have never gotten started.
Yeah.
But no, I do think he misses on the operating capital part.
Yeah, I would agree. Just the operating cash flow part is definitely, it's variable. That's probably the best way to say it, and I've gotten much better from a mindset standpoint. This was probably maybe 3 years ago. I finally got to the point too where I, just started to expect, I said, I'm just going to expect that it's going to be totally neutral every year. And I knew, just from like years of tracking, I was like, well, some years I'm definitely going to make money, but some years I might lose, I don't know, a small amount, say $7,000 or something. But once I just kind of set the bar of like, I actually just can expect to break even on the operating cash flow. And, but that, gives me the permission just to own these homes as long as I want to. And hopefully, don't sell any of them or just a few of them. yeah, with the equity growth and the tax savings, there's still substantial cash flow savings. So, or just cash accumulation, equity accumulation, whatever you want to call it.
Well, and then I am looking at your case study. I can bring it up on the screen for the audience if they want to know, but just so they kind of get a context. Thus far, you've made close to your 4-pillar returns close to 960K. And this is just what we could tell from property management software. I know you've made other very sophisticated moves. So
Yeah.
I think tax savings wise, I'm way low on what I projected. But I mean, you had a hammer of a make ready, $27,000 make ready on North Ranch.
North Ranch. Yep.
And so most new people, if they were to hear I'm going to have a $20,000 make ready, they would say, oh my God, it's over. This doesn't work.
Right.
And so could you kind of talk about your mindset on that one? By the way, you're still up 50K on that house.
Yeah, that home is appreciated really well too, which is nice.
What happened? Why was that one so big?
Well, so if I recall, there was a tenant that when they moved out, they did a number on it, and then actually it was like a double whammy because there was a tenant that just beat the place up, and that was really expensive. But then I think when it was vacant, somebody like broke in and vandalized it, and then so it was like a 17K make ready, but then like the vandalism was like 8 or 10,000 or however the number, but which was almost like comical or something because it's like what are the odds of that or something of just getting such horrible back-to-back luck, but it obviously it happens.
Back to your dad. It's hard to lose in the long run, but
yeah.
I'm sure at that moment you're like, I'm losing.
Well, I mean, it did. I mean, so if that had been my first property in my first year or two, I agree with you. There's probably definitely better than a 50% chance I'm like, screw this. Like this is BS. It's not going to work. But that was 3 years ago. I mean, that was like far enough in where I'd already kind of mentally recalibrated sort of how I'm looking at this. And I just knew the potential too. And this is where, I mean, you've always been good at coaching this. It's like, if you own enough of these, it's not if, it's when. It's just kind of a probability thing that at some point you're going to have some bad tenant experiences. But that's sort of like kind of the investment you make as an owner where, yeah, there's all this upside, and in the long run, you're going to come out and probably do very well, but there's going to be some bumps along the road that you've got to endure for the right to have that upside. And so, it just was certainly not a fun experience at the time, but I had also taken out a lot of money through cash out refis before this happened. So that's one of those things too. When I get pissed or see a new invoice, it's like, well, let me just go look at the cash out refi from a year ago. And, I'm like, well, I can't really be that pissed off, so you just have to kind of keep the big picture in mind.
What do you think you've extracted from, I call it equity milling.
Yeah.
What do you think you've equity milled from your portfolio?
About $500,000 so far.
Okay. And then I'm tracking that your investment was originally $325K.
Yeah, that sounds about right. And some of that money was through private lending where I've since paid that back, and was kind of lucky. I got lucky because I was able to do some of those transactions where by the time I kind of closed, the market, it appraised really well.
Yeah.
And so instead of putting 20% down, I was putting like, I don't know, 8% down or something, the way it worked out. So I think on my end, I track like maybe it's like 275. It's under 300,000 total. And plus there was a 1031 or two in there. So yeah, it's under 300,000.
So the way I look at it is technically you're playing with house money right now because you don't have any of your own cash into this.
Right. Yeah.
That's like that to me is like the holy grail of getting to that cash to when it's not your cash anymore. And now this is kind of growing on its own.
Yeah. Yeah. That's accurate.
And then, but you probably, I'm just looking through this kit. You probably had to buy 5 or 6 houses before you were able to get into that sphere where you could start equity milling, right?
Yes. Yeah. No, that's it's like, I think I bought 5 or 6. Then I did 1031 and I sold a house in Houston, and I was able to get 3 properties there with you guys. That was North Ranch, Old Halls, and Flamingo. And then like a year later, I sold another property in Houston.
And what was that? Did you sell your 2006 house?
Yes. Yeah. That
Nice.
2006 one's the one that I was able to buy 3 with you. And then a year later, I sold another property in Houston and was able to get 2 with you. So 5 of my properties with you were through 1031s.
So talk to everybody. You've done a lot of slick things, but the absolute slickest was getting your wife as a real estate professional. Could you kind of, because I don't even know how it all went down. I was like, yeah, you could do this, but then you figured it out.
Well, actually, it's the funny part is it's pretty straightforward and simple, just from like a requirements standpoint. And so for anyone that's a W-2 employee, which is the majority of workers.
And that's like half of our callers, and they're all looking
Okay.
for that holy grail, especially now with the Trump tax cuts, to get that instant bonus depreciation.
Yeah. Yeah. No, definitely that was huge getting that in the new legislation. But if you're a W-2 employee and you're married, and if one of the spouses is not a W-2 employee, if that spouse spends.
And your wife was a W-2 at the time, right?
She was, yeah. She was a farmer rep for 8-9 years, for quite a while, but she stopped doing that job. But to qualify as the real estate professional in her case, that means she's got to spend 750 hours, working on our real estate portfolio and doing real estate related activities. In that 750 hours, that basically is the requirement, which on paper that is pretty easy. Now, everyone can do that 750 hours. That's like 60, 70 hours of work a month. So like that, there's absolutely some real things you have to be able to do there. But what's also kind of important to know about it is there's a lot of activities too that the IRS is, they kind of structure some things where to get it 750 hours doesn't necessarily mean that you're doing, back-breaking type of work 750 hours out of the year. Like, so for example, the IRS will allow you to do an annual, sort of financial / strategy review meeting. And if you happen to travel somewhere and you conduct that meeting while you traveled out of town, well, you're able to capture the hours that are required for you to travel round trip, and so we'll drive to Colorado from Houston every summer, round trip, and then we'll spend a morning basically, and we'll do an annual update. And I keep detailed notes on everything, just looking at cash flow, leases, are we going to sell anything, et cetera. But that's like 30 hours of time right there just for the round trip. And so,
because you guys have a house up there.
What's that?
You guys have a house up there?
We don't. I mean, we're definitely gonna, get something up there sooner than later. Like, we love going up there and definitely want to spend more time up there. So
but you're saying to the IRS, hey, I'm looking at property.
Yeah. Well, so it's, they'll just give you credit for the fact that, because you were conducting business, but while you were traveling, you did that, you'll get the benefit of those additional travel hours and stuff. But what's important, the most important thing, and I've talked to several CPAs about this, and Dan Nicholson, because you helped me, Jimmy, with the referral to Entry. They've been phenomenal, but they've all been very clear. It's all about documentation. Like, document as much as possible, and like that's where like my wife does a fantastic job at that. Is we've got a log, and there's a log that's kept for, every week go in and it's like, hey, had to pay certain bills and that took an hour and a half, or just checking on properties and all the various things that happen, but just keeping a log of what's going on. And once you do it for like 3 months, it's not that hard to do, but you just got to be organized. And what I've kind of realized with it too is it's not like the IRS is like, if we're to get audited, which I'm totally fine with, it's not like they're going to kind of show up and want to read through 911 lines of my Excel log or something. But it's more of, sort of passing a smell test, if you will, of like, is it clear that somebody's operating a legitimate business and they legitimately, you can see, are doing 750 hours more of work. And so if you can demonstrate that, which usually requires documentation, then it's like, okay, cool. Like, these people they're not trying to, take advantage of something or do something fraudulent. So, that's really just, we didn't kind of figure out anything loophole-ish. It was more about, do we have 750 hours of work? And what are all the activities that are going to be required, to help us get to that point and stuff. So that is kind of more the challenging part, but it's been awesome because like we have actually sold a couple properties this year. And it's great because we're basically not going to pay any tax on any of the capital gains on those properties, which is a huge win. Even though capital gains is, way better than ordinary income, like you sell a couple properties, that's still a pretty healthy number, even at 20%.
Yeah.
So yeah, that's been a mass. And the beautiful thing about the tax break or the real estate professional status is that, that carries forward, or that's not just like a one-time win, but we can ride that, as long as we need to and stuff. And also, if you've got other investments, even outside of real estate, like other private investments, well, when you have capital gains from those, you can also you can use, the real estate depreciation to offset even those non-real estate investment capital gains. So but it goes back to having the real estate portfolio basically gives you the permission slip to unlock all those tax benefits.
I mean, and then this just came to my mind. It's like, of course, you're a human being, so you want things immediate gratification.
Yeah.
And so a lot of people won't get started in this because I believe Deanne says you need about 5 houses to qualify as a real estate professional.
It's funny. There's not a set amount, but yeah, I've heard like 5 to 10-ish, somewhere in there. Where it maybe depends too is if it's turnkey, I would think it should probably be double digit, because like your team, you guys do the bulk of the work.
Yeah.
If someone's self-managing, which I personally wouldn't really advise that, but if
Don't
some
do
people,
that.
yeah, that definitely you'll lose a lot more money in the long run doing that. But from just a pure hours involvement, well, yeah, that certainly is going to require more of your time and stuff. But you don't need a massive portfolio to do it. And the one thing I will say, and I'm not an expert at this, I'm trying to learn on it too, but I know with short-term rentals, there is something with W-2 earners where I want to say it's maybe like $200.
Yeah, I haven't announced this publicly, but you're going to love this. Now, everything we're saying, by the way, is completely authorized by the IRS.
Yeah.
And my belief is the IRS created a tax code, which is a treasure chest for enterprising people. Now, it's kind of like at West Point, Derrick. If you were just like, oh my God, someone might not like that, I might get in trouble, I'm not even going to look at the rule book. I'm just going to sit in my room in the fetal position. You have a good time at West Point.
Yes. Or no, if you do that, you will not. Yeah.
But now let's check a look at that rule book. Let's see what really happens there. And then I think we had a ton of fun because we were willing to ask questions.
Yeah.
And so same thing with the tax code. So many people just quit right away and don't ask questions. But I have an underlying belief that this country was created by real estate professionals for real estate professionals. So it's not a loophole. It's not anything nefarious. And even the Supreme Court said it's a citizen's obligation to minimize their tax burden. Judge Hand said that. But essentially, that's all you've done. But, so I was doing some homework last week, or 2 weeks ago. I was like, why didn't I ever think about this? For a W-2 employee doing short-term rentals, it requires 100 hours, right? And now this is particularly relevant because of the Trump tax codes. Like me personally, I don't want to buy a fleet of lake houses or ski houses or all that type of stuff, right? Because it just, to me, I like to aim small, miss small. That's what I like about these $200,000 houses. And I've seen especially these W-2 inexperienced employees buying $1 million ocean houses, right? Hurricanes come in and they just get slaughtered. And so what I figured out, and I don't know if this would work before the Trump tax cuts, but you could do a $200,000 house. You can buy the house in the back of the year. You could get your 100 hours. And as long as your average stay is 7 days or less, you can get the Trump tax cuts, which means the bonus depreciation year one, right? That's cool and that's fun. But I'm not sure if these $200,000 houses, how they're going to perform as Airbnbs. But I do know how they're going to perform as long-term rentals, right? So guess what you could do year two?
Convert it.
Accredited investors, if you're looking for quality real estate to put in your portfolio that is pushing 30 to 40% in annual returns, well, I'm glad you're watching this ad because I bring my investors about 400 of those deals every year, and all the due diligence is already completed. We also have all the lending lined up, and we have the construction and property management already set and ready to go. And it's all in-house, all done start to finish by my team. All you got to do is review the deal, write the check, show up at closing, and you're done. And the best part is there's no equity splits. You own the asset 100%. My team gets paid to do the things you were already going to pay for anyway, like having someone find the deal, fix up the deal, and manage the house for the long term or offload the deal for a flip. So if you want to invest in real estate and you want to build a portfolio on autopilot, or maybe just flip a few houses with a vertically integrated team doing all the work for you A to Z, click the link. There's more information on how this works on the next page and the option to book a call with us to discuss working together.
So guess what you could do year 2?
Convert it.
Yes. And you still got you already sucked out all the tax benefits. So now at this point, you play the appreciation game and you play the long-term tenant game, and you don't deal with multiple tenant, people coming into your house every year.
No, that actually, it's funny. I hadn't even thought through that, but yeah, that's a great point because,
so I bring that up because we are selling short-term rentals now.
No, but I think that's a pretty clever play, and that's smart because your point about people that will get into the short-term rental game and think, oh, I'll just get a nice place and it'll sell itself and I'll get top of the market rates and it'll always be leased. I mean, if you're not a pro at that, if they try to underwrite a short-term rental and they'll be like, oh, average, they'll look at AirDNA and think, oh, in this market, the average STR is leased 65% of the year. But
yeah,
if you're not a damn good operator, you'll be leased 50% of the year. And when you go run the numbers on 50 versus 65, that's a difference in making 10 grand and losing 20 grand, And so it's, it's not for the faint. I mean, it's like anything else. Like if you don't have professionals running it, you're going to get what you pay for.
I mean, I'm pretty experienced in this game, but right now I'm looking at a lake house to buy in an Airbnb. And even me, I'm still going to buy more hers just because I know it and it's aim small, miss small. And this to me is it's a house that I want to take my family to and get a bunch of enjoyment out of. And then maybe I'll get some Airbnb tenants to help me cover the mortgage.
Yeah. That's how we're looking like a Colorado property too is, my goal really is to break even. Sure, over time would love to have some cash flow. And that would, I'm sure, happen after 4 or 5 years, but because there's definitely going to be, kind of like the sentimental part of it too. It's, I just want to still have a short-term rental there because that'll absolutely help offset all the expenses. But it's, it's more than just kind of an investment stuff. So that helps a little bit with it.
Yeah. But to accumulate as a newbie, accumulate a bunch of that. Well, you want to hear a funny story about my 2006 rentals?
Well, yeah, let's hear.
So I was buying all of them with my brother and my parents. And so, 2016, 2017, we'd owned it for 10 years. That's all you got to do. My parents had made a ton of money, right? So my brother and I trying to do the noble thing. We're like, Mom and Dad, they're retired now. Let's get them an Airbnb down in the lake, right? And so we sold the 2006 houses, 1031 it into a lake house, Airbnb. I believe we put a 50% down payment. So there would be no debt risk, right?
Yeah.
And it drove them insane managing the Airbnb. They were like, this cost. And we're like, it doesn't matter. This is for you guys to enjoy. And it drove them insane. And they sold it in a year.
Wow.
So that's when I see new W-2 people want to get involved in this Airbnb game, I'm like, proceed with caution. Do my plan. It's smart.
Yeah. If you're not a pro or you're not working with somebody like an incredible short-term rental manager that's above average, probably not going to be thrilled with the result. Well, the other thing too is, most, or I guess kind of like a couple thoughts on Airbnbs too is people, it's not linear. You can buy like a $500,000 Airbnb and then say maybe a $1 million Airbnb. And so you're like, oh, okay, well that's, twice as expensive. But that $1 million one, if well operated, will probably generate 3 times the revenue.
Yeah.
And so that's what I think a lot of people don't realize either is if you're not willing to play the short-term rental game, kind of more towards kind of the upper, if you're trying to play that kind of in the bottom third, that's just, it's you're not going to generate the same amount of revenue and stuff. Like a 3-bedroom house compared to a 6 or 7 is a completely different. And that's where I think people, they show up with sort of like a long-term rental linear mindset, but it's not in short-term rentals. And in like a $3 million one might generate, you know, I don't know, 20x what a $500,000, or just, it's like, that's some of the stuff I've learned recently is like the top tier short-term rentals do exponentially better than, kind of some of the
Well,
less
those are
ones.
pros. It's not
Yes,
mom and pop. It's
exactly. Yeah,
pros.
that's their full-time job, and they've got pickleball courts, and they've spent 200 grand on amenities, but it's like, that's what generates a massive outsized return. But yeah, if people kind of show up thinking they're going to do the bare minimum of make ready and get it just good enough, it just, yeah, odds are they're not going to have a good experience. Or if they're thinking it's going to generate a ton more cash flow than long-term rentals, they're just probably going to be pretty disappointed.
And so I kind of want to change subjects a little bit, but like when I think about what you've done over the past 10 years, because I mean, you can speak to the audience about all the other investments you've done too. Like, I think you're one of the best examples of the passive income paradox. And so for the audience, like, passive income paradox is you get into real estate thinking cash flow equals expenses and you're going to go sit on the beach. But then it opens up this whole new world that you thought you came in looking for little passive income, but you become massively more productive. And then at that point, there's no chance you want to quit your active income.
Yeah, no, definitely something I know we've had a couple of conversations over the year, but I guess just in the last couple of years, as I've gotten, deeper into my investment journey, and the bulk of it really being the real estate piece, but some things outside of there. But as that's gotten better and those things have grown and everything, as we were talking about it, it's helped me because just in my day job, it takes a lot of pressure off of you where, if just, I don't know, say something happens in a company and maybe, don't get all the bonus or something. It's like, well, that's, sure, you don't love that, but that's not the end of the world because you've got other sources of income. But I think just the fact of taking the pressure off yourself, it allows you to play to win much more and just be more bold sort of in whatever your, kind of day job endeavor is. And so that's certainly been my experience too, where, yeah, I can look at my career trajectory and as my investments have increased, not exponentially, but as that's steadily ramped up, it's been the exact same just with my corporate career and everything. But I know a massive reason why the corporate side's done well is because the investing side, as it gets better and better, it just, this becomes more of an option and just back to the playing to win. It's completely different when, you know, if there's a mistake at a company or something, or you get bought out and sold, like, okay, maybe it's an inconvenience, but you're fine and stuff. So yeah, the passive income paradox is, it's been a great problem for me to have experienced in the last couple of years. So I'm grateful for it.
And thanks for being the guinea pig on that.
Sure, absolutely.
But I mean, you went in looking for cash flow per door, but now, I mean, your active income and promotion has scaled a lot.
Yeah.
More than your real estate portfolio. You're now a borderline tax expert. And then most importantly, you can recognize a good investment.
Yeah, absolutely.
Because I mean, I know you've made major plays in other things, but I feel like your single family journey was your training wheels.
Yeah, no. And that's like, I kind of look long-term, and like for me, single family, I always want it to be about a third of just my overall net worth, because it's just so hard to lose in single family. And, and sure, it takes time. It's not a get rich, quick scheme, but like, that's the beauty of it though, is it's built to last. And, just the simplicity of it. I mean, because I'm like in other real estate syndicates and everything with like, multifamily and commercial properties. And fortunately, like some of those things have done pretty well, but just the simplicity factor of the single family and the fact that I can do a cash out refi whenever I want, or, and say I wanted to sell a chunk of a portfolio, like there's people that will bundle a couple homes and you can do a big 1030. There's just I'd say the simplicity and the control factor of the single family is what I absolutely love, So I've, as I've expanded and kind of learned more about some other investments, I mean, that's definitely been positive and probably a good thing. But yeah, the single family core or sort of foundation. That's always going to be a huge part of my overall portfolio.
Yeah. Like the single family, it's kind of real estate jujitsu. You have maximal control, maximal options.
Yep, absolutely.
And it kind of like jujitsu. It allows you to do other martial arts because you have that base understanding. So as we wrap up the podcast, before we were talking earlier, and you were talking about, hey, how you've grown actively and professionally, but you kind of go back to the roots of, what you learned at Ranger School, what you learned in the Army and at West Point. And that's leadership.
Yeah.
And it sounds to me what you're saying, like, if you're going to recommend to somebody how to get wealthy, be a better leader, not sit on the beach.
Yeah, no, I think that's a fantastic point. And yeah, what we were talking about earlier was, I know at least for me personally, but I think probably a lot of our peers come out of the military probably have a similar experience where, serving active duty. I mean, it's an incredible experience, and all of us probably feel, pretty honored to be able to do that. But I think when we first get in corporate America, this is where I personally felt like maybe I was a couple years behind, or like I would have been better suited, you know, uh, only having served 2 years in the active duty, and would have been better off kind of learning more technical skills or financial stuff or something. But as time goes by, just realize that, the leadership experience and just when you talk about like Ranger School and, like grit and perseverance and just really a lot of just the shitty stuff the military forces you to go through. But it's a beautiful thing because you can't really quit a lot of those. I mean, you kind of can, but it's really not an option. Or I think a lot of us, if we're going to show up there, we just know like, you're going to have to kill us before we ever quit. Or that was at least kind of, go ahead.
My endearing memory of Ranger School is like we had buddies who got extracted for legitimate injuries, broken ankles. We had one classmate get gangrene. Like there's some real injuries. And I always remember when they helicoptered him out, I was just like, that lucky bastard. They had an honorable way out because you're right. We're not going to quit, and it sucked.
Yeah. Yeah. But that's where you reflect on that. So, and I think about it. I'll finish kind of the corporate thought and then come back to like kids or something. But what I realized over time is it's, like the technical skills are basically a dime a dozen, but emotionally intelligent leaders. I mean, that's the ultimate, in terms of supply and demand shortage. There's such a short supply of super highly qualified leaders. And not that everyone that goes through West Point of the Army or military is, magically a great leader, but I'm pretty sure like between, us and our peers, we're disproportionately high in that category. But like that's the secret sauce right there. Yeah. If you're an excellent leader and highly, highly emotionally intelligent, give me that over IQ all day long. And I know that's what I look for in all the leaders that I work with and everything and stuff. So yeah, just the leadership part, more and more over time, I feel like those experiences, 20, 30 years ago, while they didn't really seem to like pay dividends at 25 or 30, I feel like now kind of in our 40s and as we're, definitely getting older quicker, it's paying massive dividends and everything. So just more and more grateful for those experiences over time. And the point I was going to make on kids, because I'm sure you think about this too, is I feel like we're pretty fortunate where we grew up sort of with a perfect childhood where, we still had, plenty of like technology and like, creature comforts, but like we had to do tough stuff as kids and like we weren't coddled by and large. You think of like West Point Ranger School, like you had to figure some tough shit out, and like, I know me, I had a 2.0 my first year at West Point and should have been in summer school, but by some grace of God, I wasn't, but I look back and it's like, those are awesome experiences. Cause you learn, well, that's life. Like, it's not about finishing and being pretty, but just, sometimes you just got to get stuff done, and just being able to like persevere and make it to the next milestone. And I feel like that, with investing, that's similar too, because that's where, like you were talking about, people can get knocked out of the game early, and if you just don't have kind of the thick skin or kind of the fortitude to push through, it's like, oh, this is hard. I didn't sign up for hard. But going back to kids, that's where it's like, I try to think like, well, how can we manufacture more hard stuff for our kids because they're so coddled, and even when you think you're being hard on them, it's like we're not, or at least, I'm kind of generalizing, but just
I mean, dude,
it's a
I'm trying
different
to
environment.
figure that out.
It's hard. I mean, because yeah, it's just a different environment and stuff. So that's one of the. It's funny because like Lynn and I will talk about West Point or military academies, and there's part of me that's could kind of care less about college, or I'm like, I'd much prefer my kids to learn about how to be an entrepreneur and how to invest, and they're going to learn all that stuff. But the one thing about like West Point or a service academies, I'm like, the one thing that you can say it's a huge win is they're gonna be super homesick. They're gonna go through some dark days, and like that's where the growth comes from, where it's a different experience than going to state U and just going to frat parties 5 nights a week. So, you know, I have no idea where my kids will end up college wise or something, but like just as I reflect more, so I'm becoming an old man, it's like, yeah, there's something to be said for, how important and valuable those tough experiences are in the military.
And then, I mean, same thing investing. You had a $27,000 bank credit. It's about being anti-fragile. It's about being able to take a punch and get better from it.
Yeah. Yeah. Actually, no, that's an excellent point there too. I think with a single family, just how anti-fragile those investments are too, because I've seen stuff on the private side where, you know, there's some investments that may have a great sponsor or is a great sales pitch and they don't work out well, and stuff. And with a single family, sure, there's going to be some expensive make readies. There's going to be some headaches. There's almost kind of like a constant nag in some ways, but the floor is really, really high. And even to this day, like Lynn and I talked about it, we're like, yeah, we've only made one or two legit bad investments, but it was not with it's like even our weaker performing single family rentals, like we've still probably 2x what we put into it, and so it's like, well, that's actually. Still really good. So it's just, yeah, it's hard to lose in single family.
And so let's say you hadn't gone to Ranger School or West Point, and let's say you're trying to experience the passive income paradox and wanted to become a better leader. Where would you recommend somebody start? Because, and then it's a two-part question. What has gotten the greater return for you? Your real estate or your ability to lead?
I'll answer the second question first, because maybe I have to think about the first one a little bit more, but um, like the leadership ability, definitely is the winner for sure, but I think over the long run, I mean, it's probably just because I have like such an interest and passion in real estate. Like I'm not going to do W-2 stuff forever. So in the long run, the real estate's going to massively eclipse the leadership, but it's like the leadership's that's what's put me in position to,
It's definitely fuel it.
That's it. Yeah. Like that's what's allowed me to plant all the seeds and massively fuel it and everything. So it's, yeah, it sort of can't really have one without the other for kind of the overall success to take place. And I guess to answer your first question, if someone's not from the military, that is a great question, because even in our company, like I've got to go to Seattle next month and get a week of leadership training. And I'm like trying not to be cynical about it, because I'm like, this is such a colossal waste of time for me, but then I know that that's an arrogant statement, because there's absolutely like leadership we need, like I totally need to work on. I'm way too emotional. That's probably like my biggest weakness, or just sort of, you know, I don't know. I need better emotional control. Um, um, I guess what I would probably say to people is, and this is probably a huge bias, but I mean, I do think people that come out of the military we just have more experience and exposure to better leadership. And I'd probably say, maybe find a mentor that has quality leadership experience. Like I think those are good people to talk to.
And
That would maybe be.
So it sounds like you just told everybody to go listen to 200 episodes of Jocko's podcast.
It's funny. Yeah. I haven't listened to it, but I love it. Yeah. But that would honestly be like a fantastic start,
Yeah.
Yeah.
Or
just, or appreciate kind of like connecting the dots with like Jocko, or just actually, yeah, my favorite book too is his book, Discipline Equals Freedom, which is like a 130-page book. You can read it in like a 2-hour plane flight, but it's so incredible. It's just like, if you want good things to happen, you got to put in the work, and, there's no free lunch. But it's just, I think it's like those principles, which are so common in the military, they travel well, like whether it's in the military, whether it's corporate America, like caring about your people, even the least intelligent employee, they can tell when you don't give a shit about them, and when you're using them as a means to an end, but if you can just make people feel a little bit valued and like notice people, it like it goes a long way, and stuff. And but yeah, no, I think the job like that's a great call, or just any of the books or
After you listen to all of my podcasts, of course.
Yeah. The only reason I don't listen to his more is I don't like podcasts more than about 90 minutes or so. Like it's just too hard for me to fit. Like for me, it's like 45 minutes or less than an hour, because that's like a round trip commute, like to work, but when Jocko has those 3 hour, it's like I never made it more than like 2 hours and 10 minutes in and stuff.
Same thing with Rogan. It's a little rough.
Yeah. You kind of, it's like maybe on like a road trip, I'll listen to one of those long ones stuff. But no, yeah, I think you're right on the Jocko. Like that's a great spot, because most of what he talks about, it's like, it's simple in concept, but it's hard to, or it's like being fit and not overweight. It's calories in, calories out. Like it is so simple, but like 90% of people can't stay on the right side of the ledger, So back to the discipline equals freedom. If you don't have a good amount of discipline, you're probably never really going to pull anything off that's that impressive. I mean,
well, that's as blunt as it gets. I love it.
Yeah.
All right, Derrick. Well, I know you're a busy man. I appreciate you sharing your stories with the audience. I appreciate you sharing your time with me. Any last words for maybe somebody who's just getting started or is thinking about getting started?
Yeah. I mean, it's a little bit cliche, but it's so true. It's just don't wait. I think even for people like us, Jimmy, who've been in the real estate game for a while, still wish we would have bought 10 more houses 5 years earlier or something, but it's just get in the game. Don't try to optimize your interests or be like, well, maybe if interest rates come down a half point in 6 months, like none of us are that smart. Just get in the game. And that's the best way to plant those seeds and start winning.
Sweet. Well, thank you, Derrick. And if you found value in the podcast, please like, share, and subscribe, and share with all your friends. But thanks, Derrick, and I'll talk to you later. See you guys.
Awesome. Thanks, Jimmy.
So if you like what you heard today and you want to learn more, sign up for a discovery call with one of the Vreeland Capital success coaches at jimmyvreeland.com.